This video is brought to you by the award-winning prop firm, Fidelcrest. Folks, welcome to the first video in a series on price action here on Trading Nut. Now, we've got Rayvon FX back in the house, and today he's going to deep dive into market structure and manipulation, and then we dive all the way through his view on price action until we get to a full, complete trading strategy that you can execute at the end. So we've got the series dropping over the next few weeks. This is the first. If you want to find out more from Ray, there's a link below the video. Otherwise, let's hear from our sponsor and then get on with the show. Fidelcrest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets Fidelcrest apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
If you constantly find yourself getting lost in price action, not understanding the trend or overall order flow of the markets, I hope this video serves you well. In this video, we're going to be diving into manipulated structure. Now, I call it manipulated structure because there's so many other aspects to it rather than just a higher high and higher low. So let's go ahead and jump into the ins and outs of this and make sure to take notes. We'll also be including an outline of this video as a PDF that you can download and use as a study tool. Now, first thing first, when we talk about structure, we need to separate it between the micro and the macro. Micro is going to be our lower time frames that we're going to want to use to enter. And for me, those are H1 and down. Anything above H1, such as H2 and up, are all going to be our macro time frames. So first we need to understand the macro, because if we can understand the larger picture as far as where price wants to go, what it needs to achieve, we can then easily find entries flowing alongside it. Now, we all know the basics of structure: higher lows, higher highs, and lower lows. But when we consider macro structure, what we have to keep in mind is that in order for us to make a new high in an uptrend, we must close an actual candle body above the previous high. Okay, so in this case here, we would need an actual candle body to close above the previous high. If we just formed a wick that shot up above this level, that would not actually be a new high for us, okay? This would not count for macro structure. Now, this is the main difference of micro and macro. The thing is, there's far much more liquidity on the higher time frames, which are going to be manipulated and targeted time and time again, far more than the lower time frames. So what you'll see is a lot of liquidity grabs such as this, and then the market literally crashes back down to the sell side. So let me actually show you a couple examples of this on the chart so you can see what I mean. So overall, we can tell that this was a higher high point. So let's go ahead and mark this off. What we're gonna do is look back for our last higher low point. Now, that higher low point needs to have a 2 candlestick pullback or more. So what I'm looking for are 2 consecutive bearish candles, and the next rule I need to see is for price to trade outside of the range of the previous candle. So as you can see here, we had a bearish candle and the next one traded outside of the previous candle's range. So that would validate for me that we now have a higher low point. This is now our structure leg, higher low to higher high. So now what I'm going to do is look for price to maintain this point in order to stay in the uptrend structure. Otherwise, if we break past it, this will be a break of structure. As you can see, we actually broke this line here with a wick, but price closed above it, okay? So this technically would not be a break of structure just yet. We would have to wait until we actually close the candlestick body past that point. Now, after we actually close the candle past that point, we have been confirmed for that downtrend structure, okay? So this is going to be our transition to the downside. All right, so as we can see, price continues pushing down here. We get 3 consecutive candles pulling back, and then we get a continuation. So now we once again have a lower high to a lower low. Okay, now these do not count since they're just supply and demand or order blocks being created and continued. And also, we do not want to use dojis because it is showing us indecisiveness in the market. So now what we can see is if we drew a line based off of this lower high point, price actually beat it with this wick. But as you can see, price went right back into the bearish momentum, closing almost at the low once again. Now we ended up running the previous high and closing a candle above it. And from that point, we would now switch from this low to this high. Okay, so now we're in a uptrend structure. So we get that retracement and price ends up impulsing to a new high here. Now, just to reiterate, the reason we're using this low and this high now for the uptrend is because we did not have any 2 consecutive bearish candles that traded outside the previous range, up until we made this high and a pullback here. So once we made this pullback, we take the lowest point up to the run of the high. Okay, so now we have a new higher high point because we closed the candle above, and we will move this up until we form a 2 candlestick pullback. So as you can see, after we form this bearish candle with the long wick to the top side, we end up running the previous low. We close the candle body past it, which means we switch to a downtrend structure. So now we're going to use this high and this low as our structure points. Now this is a perfect example of what I mean about how we can be manipulated in the market. We overall had this bearish impulse leg of structure. Price shoots an extended wick to the top side, grabs liquidity, closes back bearish, and goes right back into that downtrend structure. Now, if we view this as normal structure, that would be a break and we would be looking for buy side continuation. But instead, with us understanding that we did not close a candlestick above, we are looking for that continuation to the sell side. So now that we understand macro structure a little bit better, the next thing we want to do is incorporate liquidity to truly understand what the market is doing at any given point. So let's once again start from the beginning here. We had this impulse high, and if we were to basically draw a line off of this high here, we would understand that this is representing liquidity. Now the reason is because we had a turning point here, which means that there's money sitting above this point. There's stop losses, right? Now, we all know that, for example, if I placed a sell trade here and put my stop loss above it, I placed a buy stop, okay, in equal proportion to how much my sell order is. So if I'm selling one lot, my stop loss would be a 1 lot buy order, okay, a buy stop. Now, let's consider that same concept for each of these highs and lows that we can see on the screen. So for example here, under this low of this candle, there is liquidity. As we can see, this liquidity was hunted before we retraced, okay? So this candle popped past our liquidity and closed all the way back up here, which was a range of about 50 pips. Now we can see under this wick that created the retest, we actually formed a new level of liquidity. So we can draw this out to our right. Now, as you can see on this bullish candle wick, we actually took the liquidity from under this move and started our retracement or take profit event. So hopefully you're catching on to the flow of the market. Price starts its retracements after we run a level of liquidity. Now, in this case here, these levels are going to be what we call internal liquidity because they are not structural higher lows or higher highs, or in a downtrend, lower highs and lower lows. Instead, these are just liquidity levels within a structure. So these internal liquidity levels, or what I like to also call short-term levels, are going to help you create new external liquidity or new market structure points, which will be, once again, your higher highs, higher lows, lower highs, lower lows. So nonetheless, once we actually run this last point here, which actually transitioned us to a downtrend structure, we can consider now that we had a lower high all the way down here, then we had a lower high, lower low in the structure area here. But let's look at this as in liquidity being ran. So we now understand that under this wick low here, we also have liquidity. Once we run this level, it's logical for us to think that there will be some kind of take profit event. Now, in this case, we can see that it was a very small retracement. Keep in mind, we're on the 3-hour time frame. So although it looks very small, these are still about 20 pip retracement moves that are happening. Now, from this point, we end up making another rejection, a bearish bullish rejection. Now, anytime you see a bearish bullish rejection, that means that price has hit a floor. When price hits a floor, that means that there was some kind of relief from the selling pressure, right? Which means there had to be some kind of buyer pressure here to actually make this bullish rejection. So under this level, once again, are going to be buyers stop losses. Okay, so they're going to be sell stop orders sitting under this level. Same thing happens. We run it, close a candle below it. We then retest and continue. And the same process happens over and over. For example, under this low here, we also have liquidity after we get a small retracement, continuation, and the same system happens over and over. Let's go to a little bit of a busier part on this chart. If we go to where basically price gave us that overshoot or that liquidity grab, you can see that after we had that crash back in the bearish structure, we actually broke a short-term level or a internal liquidity level, right? So we run a level of liquidity to our left that we know has stop losses under it. And then we have a little bit of a relief with these bullish candles being formed here. Now keep in mind, the whole purpose of being in bearish order flow or bearish trend is to run sell side liquidity. Now with that being said, we can now use this point as a new level of internal liquidity. Now keep in mind, this is our external liquidity, this high to this low. Until we break those points, all of these points inside are internal. So from that point, we run liquidity, we have a take profit event. We run liquidity, take profit event. Run liquidity, take profit event, and so on. So you can see how powerful this concept is once you truly understand how the market moves. So let me go ahead and just mark these points out up until this low here, and then we're going to talk about the next concept building on top of this.
All right, folks, I'm here at Black Bull Markets headquarters in Auckland, New Zealand. You can see this amazing view behind me of Auckland Harbour. Now, talking about views, if you do want to get free TradingView Pro, then all you need to do is trade one lot a month at Black Bull Markets, and they're going to give you free TradingView Pro. So, folks, to find out more, click the link in the description below or the card above.
Now that we understand that our overall macro structure was in a bearish trend, we maintained it, although we did have this liquidity grab. And we also understand that we're maintaining the run of sell-side liquidity. This means that every time we run liquidity, we're looking to take profit on our sell positions. And every time we have a take profit, we're looking to re-enter new sell positions. So let's look at how many times just flowing with the direction of the trend in order flow, we could have actually caught winning trades simply just riding them to the run of liquidity. Now, once again, this was the first run of liquidity that put us back into that overall bearish momentum. So after that, we're looking for this level to be ran. So if we were to wait for retracement and continuation, that would have been one win. Same thing here. After we ran it, we had another take profit, continuation, another win. From here, we form a new low, we get a retracement. If we're looking for shorts, we can ride it down to the run of liquidity here. So this process happens over and over. Same thing for the external level. So then price gives us a bigger pullback. So now we have a new impulse low, and this would be our new lower high. So we had a 3 candlestick pullback that led to a new low. So we still understand that we're still in bearish order flow, but now we're just looking for more continuation to the downside. So in this case here, we form a new low that gets ran. Okay, and that was another winning trade for the sell side down to the run of liquidity. Same thing here, take profit. We're now targeting the low that was created by that bounce, and it runs again, again, and so on. So if we looked at just the price action in this area, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 potential trades just in this price action that we're looking at now on the 3-hour time frame for consistent runs of liquidity. Now, I know this can be a hard concept to grasp at first, and that is why I'm doing a series where we're going to dive into each of these things even deeper. But this is going to be more of an overview so you guys can, start practicing yourselves and, pick up a lot of clues that will change your trading tremendously. So the next thing we want to incorporate on this chart is actually supply and demand and order blocks. So when we talk about supply and demand or order blocks, there are a few patterns I'm actually looking for in the market. So the most popular one that all of you should know is the bearish or bullish engulfing pattern here. So basically there's a smaller green candle, then there's a larger bearish or red candle, and this is engulfing this bullish candle. So what ends up happening is we have an area that we want to see be retested or mitigated in order for price to continue in the opposite direction. So this gives us a level of supply that we want to see be retested. Now this is going to be a point of interest for us because remember, on the time frame we're on, which is macro, the stop loss would be far too big to just take the trade off of that. Instead, what we're going to do is drop down to a micro time frame such as a M1 to M5 time frame to find an entry with a stop loss under 5 pips. Now we also have what I like to call a bearish bullish bearish pattern. This is a continuation pattern that I love seeing in the market, and it is very consistent and powerful with continuations in a specific direction. And lastly, we have a bullish bearish rejection with a smaller bearish candle, but which still leads to a continuation to the downside. Now vice versa, we also have the bullish engulfing pattern, and we want to see the same thing. We want to see price come back, retest this candlestick, and then give us continuation from it. We also have the bullish, bearish, bullish, which is the bullish version of the continuation pattern. And lastly, we have the bearish, bullish pattern with the smaller bullish candle, but which still leads to an impulse from that level. Now remember, the whole point of what we're doing right now is to build on top of each other to truly understand how the market moves. The first thing we started with was macro structure. We wanted to see what direction we're actually trading in. Number two is understanding the internal liquidity or short-term levels within it. Now we're going to make it even simpler by adding in supply and demand and order blocks. So as we can see, we ended up breaking structure at this point here. We had a continuation impulse down to a new low. Now, if we can see at this low, we actually had what we call a bearish, bullish, bearish pattern. So if we were to highlight this bullish candle within the pattern, this gives us a level of supply. Now, once again, the bearish, bullish, bearish is a continuation pattern. We want to see price fall from that level. And as you can see, we get a retest into our zone and a continuation. We then end up forming another bearish, bullish, bearish pattern, which gives us another level of supply. And as you can see, price swung up to that point, gave us a retest and crashed about 67 pips away. Now we actually had a bearish order block here that ended up being taken out, and I will explain exactly why it was taken out a little bit later. Now, as you can see, this is where we actually broke structure back to the uptrend, and then we had our retracement here. Price ends up making a bearish, bullish rejection, and then we once again go to the uptrend structure. After that, we end up breaking structure right back to that downtrend, and we form a bearish order block at the high. And once again, since this was just simply a liquidity grab, we did not get a candle body closure above it. We are looking for a continuation of sales. So we want to look for supply and demand and order blocks being created in that direction. So we have a bearish order block here. We have a bearish, bullish, bearish continuation pattern here. We have another bearish order block area there and another bearish, bullish, bearish pattern here. So as you can see, these bearish order blocks were being created as price was going to the run of liquidity. And there are actually points of interest for price to come back to for their retest. So I'm going to go ahead and drag this level across because it is the order block that created the impulse to a new low. And once again, the cycle continues. We get another bearish order block here. We get another bearish order block here, another one here, another one here, and so on. So now when we zoom out on price action, we not only know which direction market structure is, we also understand the internal liquidity and where our targets should be, but we also understand where the best areas to get into the market are based off of order blocks being created. Now, the next thing we want to add into our analysis is imbalances. Imbalances are when a candle expands past a previous candle's range and actually creates a gap where price needs to retest with a wick to fill in. So in this area, we had this bullish candle closure that had a wick low to this point. Now from this wick point, bearish candle expand past it and close here. That means price needs to come all the way back up to this wick and retest in order for price to move efficiently. So now we can understand why this bearish order block did not hold. The reason was because there was an imbalance above it, which means that price needed to overshoot or grab liquidity above this level. Now, of course, price plays off of supply and demand. And if it breaks through one level of supply, then it's simply headed to the next. And it fills the pieces of the algorithm on its way, such as filling this imbalance. Now, I'm sure you could see imbalances all over these charts. And I want to make it clear to you guys that imbalances by themselves are not powerful enough to simply trade off of. You have to correlate them with other factors such as market structure, liquidity, and order blocks or supply and demand. So we can also see, this area had an imbalance as well. So we need to see price basically fill in from this wick down to this wick. Now, there is another technique you guys can use when you're looking at imbalanced areas and understanding where price may want to retest, and that is using the 50% of the range. So in this case here, if I drew a Fibonacci from the wick low to the wick high here, what I'm doing is cutting the imbalanced range into half, okay? And what I'm looking for price to do is retest around that 50% point. Now, once again, this is part of the algorithm. You'll see this play out a lot. So as you can see in this area, as price is pushing down, we actually got a nice retest directly to that 50% point, and then another expansion, which ended up running external liquidity. We also made another imbalance here, but keep in mind for this imbalance, we were already in a downtrend structure, so we wouldn't be looking to take a buy trade off of the fill of this imbalance. Remember, you always want to flow with the direction of the higher time frame order flow. So hopefully you guys are able to understand these concepts as I'm going through it. It may take a couple times that you guys review it, but I promise you it will click. So now that we overall understand how the higher time frame flows and the different algorithms that are taking place at any given time, what we're now going to want to do is drop down to a lower time frame to actually find entry points. So let's take this price action over here for an example. We know that we're in a downtrend structure. We had a liquidity grab. We then broke a short-term low, letting us know that we're right back into the bearish momentum. We formed multiple bearish order blocks. So let's find an actual entry point based off of this order block here. Now this is the 3-hour time frame. So what we can actually do is drop down. So as you guys can see, I dropped down to the H2 time frame in this case. And what we're going to do is start refining our order blocks. So what we can see in this area is we actually had a 2-hour order block that created an impulse that broke a short-term low. Now we want to see a return to that order block, and we could look for an entry based off of that tap. So I'm going to go ahead and do is just mark this area here. I'm going to change the color so that we can break down that entry. Now the next impulse ends up happening, and we can refine this order block to this bearish candle here. So what we're doing right now is just refining our areas, making it easier to see where we actually want to see a retest from. Now in this case here, we can see that we had a bearish, bullish continuation. This is now our level of supply that we can refine to look for interactions to our right. Same thing here, we get a bearish order block directly on the 2-hour. This is a refined area now. Now, when I'm refining my order blocks for the higher time frame, I'm always just looking for the clearest order block. So as you guys can see, this bullish candle has a nice wick to the top side. It has a little wick to the bottom, but the overall candle body is actually bigger than the wick to the bottom. The bearish candle that expanded has little to no wick, which is a strong pattern. This candle here has a long wick to the top, no wick at the bottom, strong pattern. This one here has a little bit of a longer wick to the bottom side, but once again, strong bearish candle. Similar situation here, so little wick on both sides and a strong bearish candle. All right, so nonetheless, let's go ahead and mark off these retest points here. And what we're gonna do at these points is actually look for entries. Now, one more thing I want to add on to this area before we actually drop down is how you can also use the Fibonacci on order block areas. So what we can actually do is drag a fib from the high to the low here, as well as the high to the low here and the high to the low here. And what I'm doing is dragging from the base candle from a high to a low, right? Same thing here, same thing here. So in all of these situations, what we can see is that price actually retested the 50% area. Okay, so that gives us an even more refined point of interest. So let's go ahead and drop down to an entry time frame such as the 1 minute. All right, so now we're on the 1 minute time frame, which is our entry time frame. And this is that first order block that we wanted to see a retest to. So what I'm going to do is use something called MTF candles, and this is going to allow us to see the higher time frame candle at the same time as the lower time frame candle. As we can see, we have our bearish order block area here, and we wanted to see price swing back up to our level of supply. Now, after we come back to this area, what we want to see is a transition from bullish order flow to bearish order flow. So the first thing we see is that we actually break a short-term level. So we made a bearish bullish rejection, which is a floor. After we broke through it, we closed a bearish bullish bearish pattern. Okay. Now this bearish bullish bearish pattern gave us a level of supply that needed to be retested. We then ended up breaking past our previous higher low point, which transitioned us into a downtrend structure. So on this time frame, we now have a high to a low. So in order for structure to break back bullish, we need to see this high up here being invalidated. Now, something else I want you guys to keep in mind is the fact that we had a high to a low here means that this whole impulse leg broke past this structure here, which is going to equal a bearish order block on a higher time frame, maybe such as the 5 minute or 15. So let's go ahead and use the MTF candles real quick to find a time frame that shows us a clear bearish order block. So as we can see here on the 5 minute, we did get a nice bearish rejection. Let's see what else we can find. 7 minute gives us a really nice bearish order block here, which can be used as supply. Let's go ahead and put this back on the 2 hour in the background now. Okay, so this is how we use time frame correlation. We overall seen the 1 minute transition. We know the 1 minute created a new level of supply here. We know that we had an imbalance on this candle that needed to be filled in. We also know that we formed a 7-minute bearish order block, and we know that this purple area is the base that needs to be retested. We also know we're at supply based off of this 2-hour zone here. Now, once we get this retest, we could look for a bearish rejection candle such as this. We could also wait until price breaks the previous bullish candle's range, which would equal an order block on a different time frame. From that point, we could easily target a 1 to 3 risk to reward as our first target, and of course, go for higher swing trades as well. So in this case here, from this entry point, price ended up falling about 64 pips for a 1 to 17.7 risk to reward. So once again, targeting that 50% fib level, what we can see is when price gets to that point and taps it, we get a strong bearish reaction. So there are multiple ways we can approach this. Of course, it would be a lot more risky to just enter off the tap of this bullish bearish rejection candle. But what we can also do is look for the transition once again through our short-term levels. We can see that we broke 2 consecutive short-term levels here. And we also formed a new level of supply. Now, once again, as price continued to run, keep in mind this was not a break of structure, this was just a short-term low. In order to break structure, we had to pass the last higher low point that created a 2 candlestick pullback. So in this case here, this would be our break of structure. All right, now we would be looking at this impulse as in from high down to our low. If we look at this area here, we had a doji, we had 1 bullish candle that shot up, and then we had the second green candle that traded inside the range of this one here. So this one did not trade outside the previous candle's range. Now this is how we can easily get tricked in the market. If we look at these previous highs here, we can easily think that we've transitioned or broken structure to the uptrend, but in reality, these are simply liquidity. Okay, so if we think about it, we had a point A and a point B for a trend line, and as price came back to it, a lot of people are thinking that this could be a potential point C. So what are they doing? They're selling the market, placing their stop losses above it. Well, guess what price is going to do? It's going to go right above it, hit all of those stop losses and clear that liquidity, fill in the imbalance, okay? Remember, we always got to look at all the things that price needs to achieve. So price fills the imbalance and then it goes back short after people switch to their buy side bias. So once this candle closed and everyone got stopped out on sells, they switch to buys, and of course the market goes the exact opposite way to finish off the impulse move. Now, if we look at this price action here, we get a bullish candle that gets engulfed by these 2 bearish candles. So it's actually the 2-minute that ended up giving us a bearish engulfing here, but we actually had this candle expand and then the bearish candle close and trade outside the range on the 2-minute time frame. We then get a retest and a continuation from that point down to the sell side. And that rejection here actually gives us an entry point. Now, of course, if we wanted to wait a little bit longer, we actually got another bearish continuation pattern here, which we could have taken a trade off of. So if we were to highlight this whole level, keep in mind, since we're on the 1-minute time frame, this is only a 1.7 pip zone. So we could place our stop above it, and we could then once again target a 1 to 3 for our first take profit, and then extended targets, of course, to a higher time frame level. All right, now let's go ahead and break down this next trade here. Now this one is very interesting because we actually had a false movement here. We had an overall order block that we needed to be retested, and price swings up as if it's going to retest it, but it actually creates liquidity for us. It creates equal highs in this area that we now want to see price take out. So as you guys can see, we're building up a whole bunch of liquidity in this area between this order block and the highs being implemented. So as you guys can see, all these are just equal highs waiting to get ran because our point of interest is actually based off of this order block area. Now let's zoom in really quickly to our left. When we zoom in over here, we can see a couple things. We have an imbalance in this area, and we also have an imbalance under us for this whole breakout. So those are 2 points of interest that we want to keep in mind as price is pushing back into our range. It wouldn't make sense for price to just stop at this point here, understanding that there's still so much to achieve above it. So with that being said, going back to where price actually comes and retests into our level, what we can see here is that we had a strong bullish impulse up until the point that we got deeper into our zone. Now, once we did, we started to see the first signs of bears coming into the market. we started seeing breaks of short-term lows in this area. We also started seeing the creation of bearish, bullish, bearish order blocks. Now, as we start to see this transition, let's keep in mind that we do not actually break structure until we pass this previous low down here. Now, once we actually break structure, passing this low, we can see the price actually stabs right back up, and then we get another move short. So in this case, we really didn't have any entries to take the sell trade because price impulsed past our previous high so quickly. So instead, what we'd be waiting for is another break of structure, which we get right here. And now we can look for a retest to actually catch an entry. So we have our overall high here, and we want to see a retest of the order block that created the impulse. As you guys can see, price continued pushing down for a while to this low before swinging back up. So what we're going to do is update this zone to the order block that created this impulse to the downside. We get a perfect tap into it here, which is the most ideal entry point to take a short from. Now in this case, we have about a 5 pip stop loss based off of this bearish candle rejection. We can also enter here after we get the bearish engulfing variation here. And what I mean by that is simply these two bearish candles engulf this bullish candle here. We can place our stop loss above it, and once again, target 1 to 3 for the first target, and of course hold longer for our extended targets here. And as you can see, if I zoom out, this trade once again went for a crazy risk to reward. Now keep in mind, these trades that we're actually catching based off the retest of these order blocks on the macro time frame of the H3 are actually giving us an entry to catch the move of the day.
Tired of missing trades or spending hours at the charts? Introducing my Robot Builders Club. With our platform, you can build bots in minutes, not weeks, without any coding required. Get lifetime access to my video course, VIP community, and over 40 ready-made robots. Works with MT4 or MT5, and as a bonus, you'll get 3 months access to my robot lab, where we build and test bots on live calls every week. Join the hundreds of traders who are trading smarter, not harder. Click the link in the description to learn more, get the free training, and download a free robot.
So let's go ahead and break down this last retest here. We'll go ahead and wrap up this video. Now, once again, we can see price comes back up, retest into our higher time frame order block area, and we once again start to see a transition by running a short-term low. After we run a short-term low, we can see that we created a level of supply based off of this bearish bullish bearish pattern. This bearish bullish bearish pattern can be an entry point anywhere on these retests here. So for an example, let's say we wanted to enter after this long wick to the top side and put our stop loss above once again for about a 5 pip stop loss. And we can target a 1 to 3 and of course, once again, the extended targets. We then had another nice setup based off of this bearish order block on the higher time frame, where we can see a beautiful transition coming off the level. So after we tapped into it, we actually see price broke structure. We then get a return to the order block that created the impulse, right? And that is now an entry point. Now keep in mind that this video here isn't so much focused on the actual entries. I will be doing videos in the future where we go a lot deeper, and I promise it will be as clear as day to you guys how to catch these entries. But I wanted to give you guys once again an overview of how you can start on the macro time frame, understanding the overall direction and structure and the algorithm of price action, and then going to the lower time frames to find actual entries to flow with these higher time frame movements. Hopefully you guys enjoyed this video. If you did, please make sure you leave a comment, like, and share it, as well as download the free outline that is going to be attached with this video. It will help you understand the concepts of this a bit easier, and going into the next video, kind of like a little study ebook. So once again, thank you guys so much for tuning in, and I'll see you in the next video.